Good evening, everyone, and welcome to the IG Trading the General Election webinar. I'm Chris Beauchamp, Chief Market Analyst for IG UK, and we're going to start, well, we're going to run through about 45 minutes looking at the UK General Election, the outlook, where the polls are currently, and some, of course, the key thing here, the markets that might be affected, and we'll also look at some charts over the course of the session as well. Looking at sectors that might be affected most obviously, but also the FTSE 100 itself and the pound, either against the dollar or indeed against the euro. I see some people are just still logging on as we start. A reminder, this is a recorded webinar, so if you did miss it, you will be sent the recording, or if you want to listen to it again, you will get the recording via an email sent to you after the webinar. Don't forget, you can put questions in the chat box as we go. Now, my microphone says it is working properly and that the sound is good. I think somebody responded in the question box, which is great. If you could put yes in the question box there if you can hear me, just so I know that people can, because there's often someone that says they can't hear me, and if most people can hear me, then I know I can press on. Thank you very much, that's great. I've got at least 4 of you, so I know that if the sound isn't working for some people, it's not the problem on this end. Thanks very much. Right, let's push on with the webinar. Before we do that, the risk warning, which you'll see for all presentations. Don't forget the spread bets and CFDs are complex instruments and come with money. 71% of retail investor accounts lose money when trading spread bets and CFDs with IG. And then, of course, we provide an execution-only service, and so there's no investment advice or recommendation within this. And we are, of course, authorised and regulated by the Financial Conduct Authority. So we are a week away from the election. I think it has to be said that this election doesn't quite carry, I think, to be fair, the excitement that 2019 or the uncertainty that 2019 did. 2019's election came obviously before COVID, which seems a very long time ago, but it also came as the climax of three and a half years by that point, 8 years ago this week, of turmoil in the UK since the Brexit vote. There was a clear dividing line between the two parties, or a very clear dividing line. You had the Conservatives, led by Boris Johnson, promising to get Brexit done, and obviously Labour Party, led by Jeremy Corbyn, promising a very different vision of the UK economy. Now, as we know, that turned out with a huge Conservative majority, a landslide really, although in the context of what the polls currently tell us, it seems like quite a modest victory. This election, I think it has to be said, doesn't have quite that same uncertainty with it. The polls have been very clear that Labour is not just ahead, but very, very far ahead in what we expect to see. Now, polling, of course, especially now in the wake of US elections, UK elections, and Brexit and the Scottish referendum, is quite an emotive subject. So picking the poll that shows you, it's very easy to pick a poll that shows you what you want to see, I think it has to be said. So I picked this from the Politico EU website, which is essentially a poll of polls, averages out the polls over the last few weeks. And you can see, as it currently stands, we do have Labour ahead at 42%, Conservatives at 20%. This is the average of all the polls that currently come through. So if you've seen a couple, particularly in the last 24 hours from YouGov, that put the Conservatives on a much lower figure, this is the average. Reform on 17, Lib Dems on 12, 4 main parties. Now, if you are an FT subscriber, you can go and play around with their election seat calculator on their website. It's always a fun thing to do around this time of election time, any time really. You can put these numbers into the FT calculator, and they've got a model which will spit out a number. And you can see that, of course, we're dealing with the House of Commons, 650 members. The majority is 326 out of 650 seats. The model, so based on those numbers that I put from the Politico website, put them into the FT calculator, and you get 470 seats for Labour. And interestingly enough, because of the way the geographical distribution of votes and where Lib Dems and Conservatives are strong and Reform eating away at the Conservative vote, it actually means, this is quite impressive, that the Lib Dems would come out on 78 seats and the Conservatives on 71, and also Reform getting 11 seats. And below that is a little constituency map of the UK, or England certainly. I've done just for the sake of making it easier, because obviously it's S&P, Plaid Cymru, essentially throw that into to make it a bit more complicated, but there's the UK one Actually, it does include Scotland as well, I think. You can see there would give Labour a vast swathe of constituencies across the country. Now, that's merely taking the numbers based on that Politico EU website, which is a key polling website, a key political website for those who follow these things. I think it just underscores how a huge amount of gains that Labour are expected to make. And interesting, though, puts the Lib Dems as the second largest party, a position they've not held, certainly at least since the 1918 general election when Lloyd George was leader of the party. And indeed, if you look at the proper Lib Dems, because 1918 was a coalition of Lib Dems and some Conservatives, full-on Liberal Party as the opposition, i.e. the second largest party, doing the PMQs and sitting on the opposite side of the House. 1900, I think, is the last one, because the 1905 they won the 1905 election as the Liberal Party. So that is just a bit of history that of interest. I was looking at that today. It's quite an impressive development really there. But it's the huge size of the Labour majority that's quite unprecedented really. It's not just a landslide, they're calling it a super majority, a bit of a US term, but nonetheless, I think it shows you what the kind of change we're seeing in the UK political landscape. It's important to look, of course, at what the parties are offering. I've taken just the economic elements because we're dealing with this is markets. We will get on to markets in a second, but it's good if we take the picture of where we are at the moment. These are Conservative Party policies, things like reducing the public debt, promising not to increase corporation tax, looking to cut the benefits bill and sign more trade deals. That's something they've promised to do should they win the election. Looking at what Labour promise, economic stability. This is the key message, I think, for Labour is they have run the campaign. Some might say they've done it trying to say as little as possible, especially the taxation and spending elements that are coming before. But they would cap corporation taxes current level, and they obviously want to push for a net zero, get the UK to net zero, and essentially revive the economy through economic growth. Now, you could argue that everyone wants to do that, but that's the situation we're in at the moment. The Lib Dems, I think it's fair to say they are doing well in this election purely because of the collapse of the Conservative vote. But they're on their manifesto, their economic elements, investing in green infrastructure, reducing trade barriers, and that of course includes building a closer relationship with the EU, freedom of movement, customs union, reverse tax cuts for banks, and look to boost and help high street business through a new business rate. And because they're doing so well in the polls, I did look at reform that would look at obviously cutting public spending, looking to avoid pushing for net zero in order to reduce the burden on the consumer, also raising income tax thresholds, and also looking to reduce the burden on businesses and reducing national insurance. So there's the four main parties we're looking at really. The interesting thing, of course, this week is you've had the Institute for Fiscal Studies looking at what the parties have promised and being very blunt and saying essentially their phrase was a conspiracy of silence over what faces the UK economy. As they've laid out in their analysis, the UK faces a major problem of low economic growth, but a rising deficit, increasing spending, and having seen taxes increase over the past few years, they would argue there's not too much room to easily promise increase taxes without really falling on the largest swathe of the population. Now, both Labour and Conservatives and the Lib Dems also said they're looking to close tax loopholes, try and boost and improve the collection of taxes as well, to close the black hole at the heart of UK spending. It's certainly the IFS's point has been they've not really been honest with voters in the run-up to the election to lay out the scale of the challenge facing the UK economy, and that's going to be the major problem for whoever wins the election, whoever is in power. Just over a week from today, obviously being a UK general election, we should get results coming through overnight. We should know by the early hours of the morning who wins, or at least who is likely to win, and you get the exit poll at 10 PM, of course, once polling has closed. So that's the landscape we face. I managed to get through that in under 10 minutes, so that's good because the main part of the webinar is still to come. We're looking at the market impact, of course, and where we see things going and where the potential impacts are for the UK stock market. What we do know is that UK elections tend to correlate with market volatility, certainly for UK assets. This was certainly the case in 2016 with the referendum. Also 2017 when we had the snap election called by Theresa May when she was Prime Minister, and indeed in 2019 as well, when there was a lot of uncertainty. This drove a lot of money away from UK markets, I think it's fair to say. If you looked at the monthly fund manager surveys, one of the least popular areas for them to be investing in was the UK. There's a survey done by Bank of America. It says, where are you investing? And it divides it down by sectors and indeed by geographies. So it says, oh, you're investing in energy or tech or banks or retail. Also, you're putting money to work in the US, the emerging markets, in the Eurozone, in the UK. And the UK was very much down the bottom of allocations. People either taking money out or not putting more money to work in UK stocks. And that's a large reason why I think the FTSE 100 and indeed the FTSE 250 struggled against other markets. It's not just because they didn't have all the exciting tech stocks that you have in the US, but they weren't really doing even as well as their peers in the Eurozone. And it was just partly because of the flows that weren't going to the UK to push stocks higher. And of course, you need buyers to drive the market higher, essentially. You didn't have that. This election comes after about 8 months of a very strong performance for UK equities, particularly, partly because there isn't that political uncertainty. For all the differences between the Conservatives and Labour, it's not that vast chasm that there was in 2019. You were facing with a Conservative Party that's on its usual platform of higher growth, lower taxes, trying to keep public spending, keep the lid on public spending. That went well because of COVID, but that's not their fault. And you had a Labour Party led by Jeremy Corbyn promising an entirely different vision for the UK economy: nationalisation, higher spending, higher taxes, higher spending. And so there was a lot of what happens if Jeremy Corbyn gets in. And the polls were fairly solid in saying he wouldn't get in, but there was that, gosh, what happens if he does? That will lead to a sea change for the UK economy, and that kept investors away. You haven't got that now. Keir Starmer has striven to say Labour's friendly to business and not looking to tax the economy, to overly burden the economy with fresh taxes. And so that's why the UK economy, UK stocks have done better. Also because fundamentally they were cheap compared to the rest of the world over the last few months. If you've seen the surge of the FTSE 100 to record highs in March, partly because you had stocks trading at much lower valuations than their counterparts overseas. That led to a flurry of bids for UK stocks as well, being taken private, but also people piling into UK stocks because you had the S&P, Dow, NASDAQ, that sort of 22, 23, 24 times earnings. European stocks, so 15, 16, 17 times earnings in very broad terms. And then the UK, 12, I think it was 12 times earnings. Even now, I think the FTSE something like 13 times earnings. So cheap by comparison with their global peers. And all that combined together to lead to upside for UK stocks. Now, usually, history says the FTSE 250 tends to outperform the 100 in the 3 to 6 months before election day. That's usually because nothing happens every time in markets. There's no short thing in markets, as I'm sure many of you know. What's actually happened since the beginning of the year is that the 100 index has outperformed the 250 by a very impressive margin, up 6.5% for the FTSE 100 in pure price terms versus just over 3% for the FTSE 250. So I think there's a key element of people piling into these bigger UK stocks because of liquidity for whatever reason, depending on the different makeup of the indices, but certainly that hasn't been the case this time around. You've had the FTSE 100 outperforming the FTSE 250. Now, the key is really the sector impact around the elections. What do we normally see around these elements? Now, if you look at the previous election years in the UK, what has been quite a strong performer relative to other sectors has been industrial goods and services. It seems that these particular heavy industry, lighter industry as well, manufacturing, has been very, very strong. Presumably because you are seeing a lot of focus on the UK economy, there's always expectations that the parties will promise measures to boost growth for business. I think it has to be said. Unfortunately, energy is a consistent underperformer around these lines. Now, it's probably fair to say that oil and gas is often a target for politicians. It's oil and gas windfall taxes, particularly now with climate change policies coming in. the focus on how they can rein in the UK's use of oil and gas, and net zero, particularly, of course, featuring heavily in the Labour manifesto and indeed in the Lib Dems, is another reason for some sort of caution around the outlook for energy stocks, and that certainly played in this time around as well, partly because of the big fall in oil prices that we saw right down to, I think it was 6 months lows by the end of May. They rebounded since then, obviously, but focus on the wind taxes hasn't entirely gone away, so leading to plenty of caution around the industry energy stocks, whereas industrial goods, industrial services, a strong performer by comparison. And as I say, there's focus areas for energy investors. What happens with those windfall taxes? Clearly, you can't tax oil and gas out of existence, unless you're the Green Party, I suppose. But you do have a lot of support for renewable energy and a lot of subsidies. Now, there's a question of how much this will cost, where the money will be found, how much of this will fall on consumers, how much of this will fall in increased energy bills, which will hit and intensify the cost of living crisis, which has eased off over the past 6 months due to fall in inflation. So maybe we can look at some of these charts in a second for energy, home builders, retailers, and banks. Others, obviously, home builders, always very sensitive to what's being said in elections, has to be said. We know the cost of housing in the UK, limits around where people can build, and the slow pace of house building. Something like the UK needs to build around 300,000 homes a year to keep up with demand. We've not met anything like that over the past 20 years. Indeed, I'm not sure we've met anything like the necessary number of new homes since the late 70s. So you can see that the sheer problems that are causing that. So that's home builders. There will always be promises of loosening restrictions. One of the key parts of Labour's manifesto is to loosen planning restrictions. So that might help home builders. We can look at those in a second. Retailers, to the extent that it focuses on the UK economy, what that might mean. A big part of the UK economy is consumer spending, in the same way that it is in the US. What consumers do with their money. The retailers of all sorts, both on the high street, both supermarkets as well, and indeed increasingly online. And then finally, banks, which you can't really disentangle from the interest rate, the economic outlook. We've got a big debate going on in global markets, of course, at the moment about central banks and the direction of policy. Some have started to cut rates, so the ECB most notably, Canada as well. Others still on hold, but talking about cutting rates. And then even as a result of this week's Australian inflation data, you've got some investment banks, some economic outlooks calling for the Australian Central Bank, the RBA, to actually increase rates at this next meeting because of the recent uptick in inflation. There's probably a bit of an overreaction, I think, in the short term, but certainly that's the key thing to look at. So maybe if we flipped over to, we could go to the platform and have a look at some of these. I'll just change my screen over. Super, here we go. Right, let's flick over to okay, so if you search here, of course, you can look for sectors. The best way to do that is probably just type in FTSE 350, because there you'll get the full list of sectors available. So firstly, I think we could look at oil and gas, and our obvious element. Very much click add to workspace. You can let's get a longer term view up here on the weekly chart and see what we've got. And actually, it's not been a bad performance all round for this index, or this sector rather, since 2020, of course, all volatile in oil prices, but didn't really participate in the general bounce of 2020 onwards. But since then, very creditable recovery. This index, this 350 index of major oil and gas firms. Don't forget, this is oil and gas firms on the 100 and the 250 indices. So that's one to look at. So we see this one, which has bottomed out in October 2020 and actually steadily rallied. And a notable outperformer during 2022 as well, when there was focus on bear markets, particularly in highly priced tech stocks in the US, oil and gas stocks in the UK, very content to move higher, notably, of course, because of the strength of oil and gas prices as well. You had the invasion of Ukraine, concerns about supply, the inflation story as well really coming into play, but it has been the case that it's steadily gained. Pull back into the beginning of the year here to around the 8,000 level, but certainly if you look at this, your trend is clearly to the upside. You had longer term highs coming through in April, pullback since then. It's just really what you'd like to see think, if you're looking at this as a trend follower. Very, very solid rally. Weekly chart looks good from that perspective. If you go to the daily chart as well, there you've had a big rally in March, quite a decent drop since the mid-April highs, 9,800 hit, but holding for the time being above that 100-day. This is the orange line here. I've got these on my chart set up as the blue line is the 50-day moving average, or the 50-period moving average. It's just simple moving averages these. The 100-period moving average and the 200-period, which in this case was its daily. And the decent pullback here. The fact it's recovered back above the 100-day moving average, just faltering over the past couple of days at the 50-day moving average, but maybe one to bear in mind. Maintaining a bullish view, maybe a possible higher low here around 88.65 and about since then. So we'd need to see a close back below that to really put quite a bit of pressure on this particular sector. So that's one to keep an eye on. I think if we keep an eye on that one later around the oil and gas, always in focus. We could look at house builders is always interesting, I think. And again, how they daily chart first, always best to take a longer term view about what's happening in the market. Not such a great time since 2022, really fell very, very sharply. It did bottom out with a broader market. If you look at global markets, really bottomed out during the course of October 2022, strongly. The same really can't be said too much of the household goods and home construction. Now this is, it contains house builders. I think it contains a couple of other stocks that are quite a bit larger, so it slightly doesn't not a perfect tracker. There are other trackers available for this sector. But it does have plenty of house builders in it. And it's just notable that it did rally along the broader market in October of 2023 and did at least manage to hit its highest level in about 2 years there, and falling back below the 200-week moving average. Going to the daily chart, perhaps looking for entry points. Again, not a bad trend since October, has to be said. So if there are election worries coming to play, and it's of course for this sector, it's very hard to disentangle this from the Bank of England and what the home builder sector will do. That's the key thing to bear in mind. You had this low in April around 12,285. It's not back there yet, so we still could be in higher low territory here, which would maintain the bullish view. I think if you get a close again, nice to see it back above the 100-day moving average if you think it's going to keep moving higher. And I suppose you might argue if the Bank of England did cut rates in August, it would then perhaps spur activity in the sector and lead to a bit of a decent bounce. So one to bear in mind there, really, particularly onwards towards these highs from May around 14,360. And if we're looking at other sectors, I suppose retailers. No, let's look at banks. Always a good one, an obvious one, really, really popular. Lloyd's, one of the most popular stocks on the IG platform. It's volatile stock, has to be said, but still very, very popular. NatWest, HSBC also up there as well. And again, always, I think, go with the weekly chart to start with. Look at the steady recovery from 2020. Unsurprisingly, of course, it doesn't take much genius to point out that it wasn't a great time for the global economy, but since then has recovered. Mostly flat in 22. Has taken a year really or more to get above the February 2023 highs, because we had, of course, that Silicon Valley banking crisis and Credit Suisse during the course of February and March of 2023. But the sector held up reasonably well. Lloyd's has done particularly well actually since then. If we actually looked at Lloyd's itself, maybe, since it's such a popular stock on the platform, always crops up in the sort of top 20 stocks most traded by clients. Weekly chart there, you can see since February it's really found its strength to the upside. We're back now just at the 17th January 2022 highs. So really impressive performance there for that stock. Like you can't hear the plane in the back. Really good strong performance from February onwards, I think, and consolidating really around these highs. Decent test of the 50-day moving average, but there you go, higher highs, higher lows all the way through. That is the very definition of an uptrend. And that's, and the key thing to bear in mind, even if you, and of course, Lloyd's really, I think it's the biggest mortgage provider in the UK. So yes, in one sense, if the bank does cut rates and reduces the interest rates on mortgages, that hits their income. But I think ultimately the bank would rather be selling more mortgages, chivvy up the housing sector. So that's a good one as well to watch Lloyd's around the election, indeed UK banks more generally. Good. That's always get stuck in the charts and talking over them quite a lot. So I hope that's a useful look at the sector. We couldn't not talk about the pound. Either we'll do the pound and then we'll do FTSE. It would be an understatement to say that you've seen a lot of volatility in sterling because of political volatility in recent years, 8 years now since the Brexit referendum. And that, of course, has been a huge movement. But you don't just have Brexit. You have, of course, 2019 and the uncertainty around that. And then you can't avoid the elephant in the room, because Conservatives would be desperate to do so, Liz Truss and the October 2022 budget, which did not really go well, I think. Now, it's not a political webinar, so we're not going to debate what the right moves were around that, what the response was overdone, but certainly you also had that huge low in sterling. You know, inevitably when you get big falls in currencies, certainly for sterling and the euro, there's always, it's going to parity against the US dollar. Not to be blindly contrarian, but it always makes me think when the line about parity is brought up, it probably shows you that the low is probably in that currency or is very close for the time being. And lo and behold, that low in sterling post the Liz Truss budget, or the quasi-Kwarteng budget, I suppose, to be fair, and there was talk of parity, and that was where the pound bottomed out. And if you'd had the bravery, or you might have said the foolishness at that point, given the way the pound was going, to buy the pound at that level, it would have been a really good trade on the upside. But needless to say, as you can see, there's good chart from Reuters here today. Volatility, there's a lot of volatility around sterling in these particular events. And it's a fundamental point that it's not the strongest economy in the world. And you've got high levels of debt, you've got a weaker economy, and it has been a major problem and causes risks for the currency. So that's as well something to bear in mind as heading to this election. But it's not the same, the stakes aren't sort of as high in the same way as they were in 2019, or certainly around the Brexit referendum. What you have seen, of course, for the pound is a bit of a recovery. If we flip quickly back to the chart, if I change my screen again, go back to where we were. We go to FX markets, the pound against the dollar. Important to bear in mind, you can see that here. Not a bad performance all told from the pound, just still struggling really in a bit of a range, I think it has to be said. We hit 128 at the end of last year. We dipped down towards 124 in April, recovered since then. There's a bit of a not make or break moment for the pound here, but certainly we're still just about in higher low territory. Don't forget, it's half this is about pound in the UK, half this, more than half you might argue, is about the US and the Fed, and you get PC data, that other US inflation print tomorrow, that might, if you get that comes in weaker, it might weaken the US dollar and then give us the chance for a rebound in the pound. So watching this one, close above 127 would certainly sort of give hope of a fresh rebound towards 128 and higher, and put this back in really uptrend territory. You've got the 200-day moving average still moving higher, 50-day moving average above the 200-day. So maybe we get an uptrend forming here with the first real higher low here. But undoubtedly the pound is usually volatile around these political events. I suspect, famous last words, that it won't be as much this time around, because though Labour's almost certain to get in, and they're usually viewed as not being as keen on, how do I put this? Conservatives are seen more as pro-business than Labour. It's certainly not Jeremy Corbyn's Labour Party. So the fear around in markets about what might happen is certainly not there. It's been a key plank of the Labour manifesto, is to calm everyone. If we do get in, and they always say that carefully, even though the polls put them so far ahead, if we do get in, we will be pro-business. We won't look to tax and spend, repeat the mistakes of the pre-financial crisis, all these kind of things. So you've seen, that's why you've seen the pound relatively calm. Yes, it's dropped back from those June highs, but that's probably more to do with the Bank of England maybe beginning to hint somewhat more strongly that a rate cut is on the way. And then finally, let's stay on the platform and let's go over to the FTSE 100. Always, of course, one of the most popular indices on the platform, one of the most popular markets overall. Such a strong performer over the last few years, really. Over the last few months, has to be said. Weakening in the short term, really, it looked like it bottomed out over the course of the past 2 weeks, but we hit 8,300 by the end of last week, and we've just surrendered those gains. So just putting a bit more pressure on the index. Of course, the stronger pound does tend to do that. FTSE 100 very much an international index, but it's still quoted all the time on the BBC and such as the stock market. but definitely one to watch. Still, as I say, still cheap compared to its neighbours and its peers around the globe. This is the key thing. Once the election is out of the way, what happens next? I wouldn't be surprised, to be honest with you. Yes, it's entering the summer and it's never a great period for markets, but I wouldn't be surprised to see the same story return. The FTSE 100 is cheaper than its rivals, therefore it's still got reason to move higher, even though we saw a record high just a couple of months ago. I'm rapidly getting towards, see, whenever we get to the charts, it always tends to take longer, so we'll move on rapidly now. Get back to the presentation, and hopefully we can have time for questions. We did have one question, so which companies, markets are worth investing in, and I hope I've covered that over the course of the last 10 minutes or so. It's important to get the sector focus in, really. So if we go on now to, we see next, of course, we're writing the presentation this morning. Obviously it's a UK election webinar. It's fair to say the election is now more interesting than it was when it was first called by the Prime Minister about a month ago. But I think you can't talk about elections this year without talking about now the two elephants in the room. Firstly, the French elections. First round, the problem with French elections, of course, is there's two rounds, so it's harder to say what the end result will be. But I think there's obviously perhaps the bigger risk is going to be the French elections. For the first reason is the outcome in the UK is certain. There's a Labour win. I don't think I can argumentative point to say that. I think it's obvious, really. The only uncertainty is how big the majority will be. But across the English Channel, you have the French elections, called by President Macron as a way of trying to defang the far right and reassert the strength of his party in the National Assembly. It's fair to say that's not really gone to plan, I think. Problem is that you've now got not just the strong far right, but also a resurgent far left. And this is almost more problem that suddenly they find that it was previously going to be an election of, well, it's either us or the far right. And so Macron's gamble was that everyone would come back to him. Now it's, well, it's kind of us, but you've also got two very strong alternatives in the form of the far right and a new popular front. Amazing how we talk about a popular front in French politics once again. Very much a focus in the interwar period, the Popular Front. So now you've got two competing alliances, if you like, that offer alternatives in the French view to Macron's party and are squeezing them in the middle. The risk is, of course, there's no clear winner. You could get political paralysis, namely both parties unable to govern, or in the case of the National Front, saying they wouldn't govern unless they had a clear majority. And we've already seen some of this tension in the CAC 40 dropping rapidly to its 6-month lows, I think it is, but also the tension in French bond yield going higher. So that's a major problem too. I think the other thing to bear in mind is that if you have obviously another, well, it wouldn't be a mini Eurozone crisis, it could be quite a significant crisis. It has to be said that that would then raise the risk of France going the same way as, say, Spain or certainly Italy, when you've had, if you remember the Eurozone crises, you had to have a technocratic government installed. I had Mario Monti, a former, who was formerly president of Italy, but had been installed without a vote, but essentially put in place to calm markets, to calm the bond markets, really, most importantly, and had the ECB as well stepping in to say that they would do what it takes to save the Eurozone. If you remember Mario Draghi's, we will do what it takes and it will be enough, his famous comment that really essentially ended the Eurozone crisis. But there's obviously that big risk there for the CAC 40 and indeed other European indices. DAX notably has recovered a little bit with the CAC 40 still languishing, but if you have an outbreak of instability in France, then it could really, I think, put a pressure on European indices generally. And the FTSE 100, FTSE 250 pound would not be immune from that. If you have a general risk-off move across markets, don't forget when you get these really big risk-off moves, such as we saw in 2022, everything is affected at the same time, and markets are unlikely to be discerning about what they sell. So it is a possibility. I'm not saying it will be, but I think it wouldn't be sensible to have done a UK election webinar and declared it was all fine and hunky-dory in terms of the political outlook without saying, but there's also the French election. So the first round is Sunday. We should get the results from the afternoon, but the problem is it's another week and then you get the second round, and only then will the result become clear. So there's a whole week where markets will still be waiting. And I think that's why European indices still remain under pressure. They haven't rebounded, although they look arguably cheaper than they were a couple of months ago. And then finally, in obviously the dying minutes of this webinar, and then we'll do questions. I don't want to leave those out. It's the US election. Most likely to be the more exciting I think it has to be said, not to sort of go all West Wing on everybody, but it definitely is the key thing to bear in mind. It's the biggest economy in the world. It's vital in terms of political direction, economic direction, what will happen here. We had, if you remember from 2016, 538, Nate Silver's prediction website was the one. It did say Hillary Clinton would win, but it said there was a chance that Trump would win. They run their 40,000 simulations or whatever it is they do, and they did put Trump ahead, I think, in 60% of those simulations. Currently, though, from this 270 to win website, which looks at the polling in the US, of course, it's much more complicated with the Electoral College and not just the popular vote, is putting Trump just a fraction ahead on the average of 9 polls, the last one being done just yesterday. So that's a key one to bear in mind. If you thought the French election was going to be exciting and the market impact was going to be big, well, then there's US election. For the people looking at it, I think there's one thing to bear in mind. We all remember, a lot of us remember 2016 and how it was such a surprise that Trump won, and the volatility that we saw on election night and indeed around before and after, in the days before and after the election result, because he wasn't expected to win. He assumed it as an unknown quantity, and of course he had a sell-off in indices into the election, and then this huge rally in the wake of it, because suddenly people realized that the world, to be fair, wasn't going to end just because Trump had been elected president the first time. People are kind of expecting this again, and I don't think that's likely to happen, in the famous last word, because he's viewed as a known quantity this time around. To borrow a phrase from another famous US politician, he's been a known this time. He might be a bit of a different president, to say the least, this time around, but certainly there's not that sort of uncertainty. Oh goodness, what will happen if he gets in? What will we do? Maybe it's fairer this time around, but I think the initial market reaction won't be as big. So I don't think you usually see volatility in US indices around elections. Usually there's, in election years, the US market tends to rally in September, October, and then fall back into November and around the election result, and then it rallies again. This is what you might get again this year, so it's perfectly normal for election year, but it'd be interesting to see. At the moment, as I say, the polls are currently edging it for Donald Trump, and 270 to win's website just gives him more Electoral College votes at the moment than Biden's, but there is still quite a bit to play for. So that's just one thing to bear in mind. So yes, the UK election clearly is the focus of this webinar, but it's really, I think, going to be attention rapidly shifting to France, and then of course, obviously to the US. There's no escaping that particular elephant. That's definitely one to bear in mind. Don't forget to ask questions. I've got about probably, where are we now? It's 37 minutes, so about 8 minutes at most of the webinar left. I've got one question so far about how long can the Fed hold rates with unsustainable debt, and how many cuts do you expect this year from the Fed and the Bank of England? I think you get one maybe from the Bank of England. Sorry if anyone with mortgages are expiring this year, probably one maybe in August, maybe two if inflation did drop significantly more. I'm almost in the camp now with the Fed though, where you don't get any. Now I know there's an argument saying they could cut in September. I think the problem with the Fed is they have to be seen as apolitical, and therefore they can't, I would argue, and there's a strong argument made for, they can't cut rates in September because it risks them being accused of favouring the incumbent president. So that does sort of militate. But then again, they themselves say they still expect to cut twice in 2024. Now, the thing is to remember, of course, we came into 2024 expecting 6 rate cuts, which is ridiculously overexcited, I think. And now we're still expecting 2, although some people don't think we get any. I think there's a high risk we don't get any, maybe in December. 1, 2 obviously at most is what the Fed's predicting as well, but maybe 1 is more likely. But what we've learned over the past year is that markets can keep rallying even if there's no rate cuts. The crucial thing is there's no more rate hikes, and say, well, yeah, that's where I think things might get a bit dicey. But yes, it's notable when you talk about unsustainable debt. People have worried about the US national debt since it was created in 1793. If you look at US newspapers, every 30 years or so, there's a worry about the debt. I'm not saying you shouldn't worry about it, and obviously the trajectory is unsustainable. And it's a similar case to the UK. There's serious questions of what happens next. But they have been here before worrying about the debt and the deficit. VIX, someone else just asking, VIX is very low compared to lots going on in the political arena. Yes, it is. We are living in an era of remarkably low volatility despite what's going on around the globe. The key thing to remember is that periods of low volatility can continue longer than anyone expects. There's an assumption that elections will drive volatility. As I said at the beginning, the UK election this year isn't quite the exciting element, shall I say, the uncertain element that it was in 2019. And as I said just a minute ago, I don't think the US is either. You've got two, one of whom president before, one is incumbent. So the markets roughly know what to expect, all things being equal. There's always the chance of surprises, but it wouldn't be surprising to see, yes, a bump in the VIX. Usually the VIX goes up when stocks go down. So if you do get your expected September, October pullback in US indices, you should see a spike in the VIX. But I wouldn't think we're heading to crisis level particularly. So one thing to bear in mind. I don't. People are saying, "Oh, major correction crashes on the way." No, from the signs of it, no. There needs to be a proper exogenous shock for that to happen, and I can't see them coming. Unfortunately, if I could, that would make me a genius or something more than that. There just isn't signs of it. There isn't even a sign of recession at the moment, so it doesn't look like we've got signs of any sort of major reason to actually have a crash for the time being. And markets continue to rally, especially with the VIX being quiet. Look at 2017, markets continue to rally throughout the year. We had a very quiet year, but very strong upside. Yes, 2018 was more volatile, but it's not impossible that you have further gains into the end of the year. There's one more question. Market reaction on election day mean volatility higher or remaining the same? I think it's probable that the Labour win is priced in by markets. So I don't expect, again, famous last words, to have a huge burst in volatility. But I think it's something to bear in mind that there is some risk around it, depending, I think, on how really now it's not about the Labour win, it's about how many they get, how few the Conservatives get, or indeed how many, to be fair to them, and of course reform as well. What happens with all that? It's a lot more interesting now, I think, than it was even just a couple of weeks ago. We know how the campaign was going to play out in terms of numbers for Labour. It's now what's happening in the rest of it. Who's going to be the second largest party come the 5th of July, and how strong will reform be in the Houses of Parliament after that? Definitely one to bear in mind. Any more questions from anybody? What's my year forecast for the FTSE range to year end? Oh my goodness. If history is any guide, if I flip over again to the chart, so just bear with me a second so we can just talk over the chart, because it's always helpful. History is any guide and you see further gains into year end, I think we could get back to those record highs. There's so much to depend on, but if we consider the relatively benign economic conditions to carry on, maybe we see up towards 8,600 by year end. If a positive year, I think it wouldn't be particularly aggressive call, I think, to make to say we get back in that direction. Certainly by the end of the year, maybe a little bit earlier, but probably by the end of the year, I think it's fair enough to say. Well, a couple more coming through, so I want to get through those. What sector would benefit if there isn't the expected big Labour majority? That's an interesting one, really. Maybe energy stocks would do better than others because of the fact there might be less push for a windfall tax. And the problem is for Labour, their big majority means they're going to get a lot of MPs who are, it's fair to say, on the left of the party who will push for this kind of thing. So that would help, I think. It might make it more difficult as well to get through maybe some liberalisation of planning processes. So that could be a problem as well. It might not do. So house builders might not do as well, I think. One to gold. I don't think gold will be particularly affected by the UK election. So I don't think there'd be huge moves around that. Gold is far more driven by the inflation outlook into the US and the US dollar, which has strengthened. That's why gold has taken a bit of a knock, although it remains above 22.80. Gosh, they all come through right at the end. Gosh, you always like to save your questions. Is it safe or risky trading on election day? It's a very fair question. Trading around events always means you are trading into higher volatility, particularly of course if you're trading overnight where liquidity is much thinner. So if you are trading around that, and there's no need to actually do so, but if you are, it's risk management is even more important than it was before. So you're looking at keeping those positions low, keeping those stops wide. So there's a perfectly good argument if you said leave election day, let the dust settle and go from there, I think, particularly. So I don't feel the need to be trading it. If there is a reaction, if say there's a sustained rally in some sectors after, there'll be plenty of time for that to happen in the days and weeks after the election. And then last question, how would you expect the markets to react if there was a shock upset, if the Conservative Party become a majority in a form of coalition? That, I still think they'll be fairly calm, because it's Conservative Party, to be fair, they've had 14 years in power, so they're kind of running out of ideas, I think, but it will probably be a general a shrug of shoulders acceptance, essentially. If there's coalition, of course, that might lead to a bit more volatility, because there would be the few days and weeks potentially around the formation of that. If they were just ahead, there would be a lot of courting of the Lib Dems, I think, by both sides. So there could be some increased volatility, particularly in the pound and UK bonds, if you get that. So that is the one interesting one. Very good question, actually, there. Thank you for asking that, where you could get some volatility. On the current polling, though, has to be said, it doesn't look very likely. But there we go. Who knows at this point? Polls can be wrong. They have been wrong before. Brilliant. Thank you, everyone. That's been it for me. I hope you found it interesting. It's been actually a more interesting webinar than I thought it would be, to be fair, when we said we'd do it. So I think I'm glad we've done it. Thank you, everyone, who attended. And if we didn't attend, of course, we'll send the recording out as well. We'll try and slice this up and put it on the website and share it around on social media as well, but we will send the recording as well, and I'll be able to attach the presentation too, just so you've got that. But thank you very much, everyone, for attending. I hope you have a good evening, and we'll see where we are in a week's time. Good night.